barrier-wise, attending those auctions, you have to be there locally, right? You got to do your underwriting just like you're buying a property. It's not that much different than buying normal real estate. Where it gets tricky is two areas. One is
this podcast is for informational purposes only and does not constitute financial, legal, or investment advice. Please consult a professional advisor before making decisions based on what you hear on this show.
Welcome to that Wall Street Tribe. Excited to introduce Mr. Brian Seidensticker to you. Brian, welcome to the show.
Thanks, Joey. Thanks for having me.
Brian, most investors don't even know what tax lien or tax deed investing is, including me and Joey. So tell us, one, why should we care about this right now?
But at a high level, right, yes, it's a segment most people have never heard of, but it's about a $9 billion ish industry annually, kind of on par with I think NBA last time I checked, and I think most people have heard of the NBA. So it's a fairly sizable niche, even though it is definitely a niche within real estate. And I think the other thing that most people know, two guarantees in life, right? Yeah, death and taxes, unfortunately. And with taxes, this is specific to property taxes, is most people don't know what happens with their home if they don't pay the property taxes. And that's kind of where tax sales, as I call them, comes in. There's both tax liens and tax deeds fall into that. There's even a muddled middle ground that we call redeemable deeds, which we can certainly dive down any of those rabbit holes if you guys like. But it's kind of it's a unique investment that is counter-cyclical. And what I mean is typically in a recession, the volume of those type of purchases goes up and the return of those assets goes up. And it's also a fairly decent sized volume for folks looking to place capital somewhere in a segment that they haven't done before.
How many summers do you have left with your kids? 10, maybe less?
And are you spending them together, or are you still stuck in the office while time slips by?
You want freedom. That's not the problem. The problem is you don't have a system that buys back your time. Without it, 3 years from now, your kids will be older and they won't care that your business was more successful. They'll remember you weren't there.
That's why we built the Passive Income Operating System, the plan we use to create over $50,000 a month in passive income. The system isn't free, but the training that shows you how it works is, and it's under an hour.
Go to wealthwithoutwallstreet.com/PIOS. Take the first step to buying back your time now.
Brian, that's a super high view, and I think we can dig into some of those specifics. But first of all, how did you even get into this world? Like, you weren't always a tax lien investor, right?
No, I did not grow up with childhood aspirations of being a tax sale guy. That's for sure. I actually got into space on the wrong side of a tax lien. I was I had an early 20s crisis, as I call it, in college, and realized maybe engineering is not all that I wanted it to be. And so I started, flipping homes on the side. It was never large enough to ultimately be detrimental when I came across this wrong side of the scenario. But I started buying houses, fixing and flipping them. And in 2008, 7, 8, when the crash happened, I was upside down on one of those houses. I was flipping in Montana. And actually, the weird thing, and the only reason I probably investigated it is in Montana, tax investors are actually required, each investor is required to send a letter to the homeowner, right, saying, hey, I might buy a lien on your home. Here's the ramifications. And so I got a bunch of letters, 20, 30, maybe 40 letters, all with varying language. But they all basically said, hey, pay these taxes. If you don't, I'll buy the lien. And if you don't pay me back with interest, then I could own your home, right? And that, on one hand, I was like, holy crap, I got to figure this out. So I paid the taxes to figure it out. But it sent me down this path of figuring out this industry that I had no idea existed, and ended up being a fairly sizable industry, and educated myself and pivoted and started buying tax liens about a year later.
Hey, break down the difference between tax lien and tax deed for us.
Yeah, so I might help to understand the cycle of how real estate taxes are enforced, right? And so if you don't pay your property taxes, state changes their, or each state has different statutes, but in general, they put a lien on your property first, right? And then some states the counties will sell that lien to a third party, because ultimately the counties they just need their money to balance their budget. They need to pay the firemen, pay the teachers, pave the roads, etc. So they'll sell that lien right at face value. So if you had $1,400 in taxes, they'll sell that. Investor comes in and pays the $1,400 to the county. And in return, right, the investor essentially gets the interest on that, which equates to the penalty that the homeowner pays when as most do eventually pay their property taxes. The investor gets that interest in that return, and that's the tax lien side of it. Now, if you go long enough, or the property owner goes long enough without paying the property taxes, or maybe never does, then the lien holder can implement a foreclosure process, very similar to a mortgage. And in that foreclosure process, that results in the sale of the actual property. Now, the sale of the property is what I call a tax deed. You're getting an actual deed for the property. You don't just have a lien on the property and interest in it. That's the difference of the two.
And you said it does vary from state to state as to how those things are handled.
Right.
What are the, so at face value, someone says, well, why wouldn't I just buy a bunch of houses for the deed, the tax deed? It seems like a ridiculously, economical way to buy property. Like what's the challenge there? What's the hurdle from this just being everybody buying houses this way?
Yeah, well, I think the short answer is yes, and it can be, right? And we can talk about this as well, but typically you can buy tax deeds, at a discount, right? Now, you're not buying them. I think the myth that's out there is you can buy properties for just the back taxes, and that's not reality. There used to be a process of buying the lien, foreclose on the lien, and you end up owning the property for the taxes plus multiple years interest. The Supreme Court struck that down a couple of years ago, so that's not constitutional. And so states that had that process are having to change their process. And so you're really left with, what is the tax deed auction? Well, it's a standard auction similar to what people picture. You're going to an auction and there's a bunch of other people bidding, and it might start at what the back taxes are, but ultimately gets sold for whoever's willing to pay the most for that property. And so you're not buying it for 5 cents on the dollar. You're fine. In some areas you're buying it for at market value. I can tell you, at least in recent years, South Florida, you don't get much of a deal buying tax deeds at auctions, but there are areas in the country where you can still get great deals, right? And so, barrier wise, attending those auctions, you have to be there locally, right? You got to do your underwriting just like you're buying a property. It's not that much different than buying normal real estate. Where it gets tricky is two areas. One is you have to have the cash the day of the auction when you buy these things, and you're there. And literally you win the auction, and a lot of it, you go down to the front of the room, you give them all these cashier's checks. That's the purchase. And so you don't have the option of like buying normal real estate. You win, or you want to buy a piece of real estate, then you go get the financing, and 30, 60 days later you close. You don't have that luxury. And so cash, right, is a very big issue for a lot of investors in the space. The other thing that folks deal with that I think most people don't recognize or think about is the title end of it. When you're buying at these auctions, is essentially what equates to what's called a tax deed, but it's like a quitclaim deed. Most people are more familiar with that. Basically, it's saying, hey, yeah, you own this property, but that doesn't mean anybody else can't come out of the blue. And if there's a mortgage on the property, most of the time the mortgage is wiped out, but other liens might be there. It's all the garbage, I call it. So when you're underwriting these properties, you're not only underwriting the asset, right, for property value. Most people are familiar with that. You're underwriting the title, and most people are not familiar with how to do that. And that's really the biggest hurdle, is understanding how to underwrite the title of tax deeds. That's why it can be a great avenue for buying and getting a deal if you know what you're doing.
All right, I'm going to try to replay what I heard you say, and you tell me where I get it right, where I get it wrong. Okay. So the first step is someone starts out with potentially a tax lien, where they buy the back taxes due on a property. They get paid a specific interest, and every state's a little bit different, and they collect interest, and eventually the homeowner comes just like you did and pays those taxes back. The investor gets their principal back plus the interest on that principal. Deal's done. In the event that someone doesn't come back and pay back those back taxes plus the interest, then a time frame eclipses where the person who owns the tax lien can then foreclose on the property in an effort to get the tax deed. In the past, it sounds like that person could actually potentially get that home just for what they had put into the deal plus interest. But in this situation, you're saying those rules are changing. So now the tax deed is going to go to an auction. And maybe they get it for that, but a lot of times that's going to get bid up and people are going to pay a higher price. So it's going, and they're going to get their money back, assuming at that tax deed auction for whatever they had in the tax lien plus their interest. They're going to get paid no matter what the tax lien person, but there's somebody else could not even have gone through that process, just start buying properties at the auction, but only if you have cash. There's no coming back and financing the deal down the road, which, by the way, our audience loves this because they do infinite banking, which is where they store lots of cash and cash value of whole life insurance contracts. So they can actually, go to the insurance company, get a check, put it in their account, or even get a line of credit against that if they want to, so they can go and write checks at that auction. It sounds like there was an option for them to do that. But your company has figured out there's a more efficient way to do that, because I know that you guys are providing like resources specifically to people in the tax deed space. Talk about like, what is it, just the ability to do all that title work you were talking about? What are the challenges that the resources that your team's providing that's helping to make this a more efficient process? Because I'm trying to figure this out. Like, is this something, I need to convince Joey that we need to do, but I need to understand, like, how do I make this easier?
Yeah. Well, I'll commend you with you regurgitating what I said, and you captured almost everything spot on, right, as far as understanding of how the process works. Now, the nuance is that each state's slightly different. Like the time period is different, the interest rate you get is different, but the overall process you described is spot on. When it comes to the tools that we provide, I think one of the trickiest things initially when I got in the space is just knowing when and where and what properties are in these auctions. And that's really the primary thing that TaxL Resources did and still does today is we track about 9,000 of these auctions a year, equates to about 1.2 million properties and about $8 to $9 billion of transactions done. So that's step number one. And then it's, knowing, okay, here's the list of properties, but which properties are worth buying, which ones are not, because the county, they're not set out to screw anybody, right? But they don't make any determination of what's worth buying or not. They just put everything that's delinquent up for sale. And so it can be anything from a multi-million-dollar, office building to a mailbox, right? Or a chunk of sidewalk, right? With weird parcel numbers and boundaries. So the investor needs to do their underwriting. And so we have a tool, Tax Resources has a tool to help folks underwrite those properties as well. Now, the next level type of tools that we provide for investors is, yes, if you've got some cash, right? And there might be, some folks on here, in my view, you need, $2 to $5 million in cash to really do this full time. Because you get rid of a lot of the competition by acquiring higher end properties. And so you're not spending $10,000, $20,000, you're spending hundreds of $1,000s per asset, right? And you can usually do, 10 or so properties at a time. And so some folks might have access to that level of capital, but those that don't, they're typically cash limited. And so we started a fund that allows them to access the capital that we have to buy more assets, and essentially enabling them to do what they have already been doing successfully, just on a larger scale. The other thing that we do in that piece of our program and tools that we provide is we actually do all of the data analytics in the background as well. I think that the sexy latest term out there is AI. And AI is essentially a fancy algorithm, and which is what we built, and essentially looks at all of the results nationwide where we have them, because we track that. And we know where not to buy properties, where you're not going to get good deals, and where to buy properties and where you're going to get good deals. So we point people in the right direction as well.
Okay, man. Russ, my head is spinning a little bit here, because what I just heard is, yes, you can be a tax lien investor. You can go to auctions. You can, research, underwrite, educate, all these things around this whole tax lien, tax deed investing. And you have to have a lot of capital, and then you get involved that way. Or you can just put money in a fund that does it all for you. Did you hear that, Russ?
Yeah, I did. One thing I want to ask, so real quick, Brian, I do want to ask about the fund because I know there's people that are just passive investors. They want to understand how that works, and they've invested in lots of different types of syndications, but not in this. You said that there are markets you guys have identified that are good markets, but also there are some that you don't think there's good deals in. Talk a little bit about that. What is a good market and what's not?
Yeah, it really comes down to what kind of a discount are you expecting to get on that particular type of property in that particular area. And so, the AI that we build essentially looks at our analytics and says, hey, based on that particular property in that area, other properties are selling at auction for X dollars, right? And based on the value of that asset, this is what we think it's going to sell for. And it's similar to, if you get a BPO or comps, right, of like MLS comps, Zillow, right, that it's pretty straightforward for normal real estate today, but knowing what stuff is going to sell out of these auctions doesn't exist. And that's a piece of the puzzle that we've put together. And you're exactly right. There are some areas of the country where you can do all the work and you can go to the auction and one of two things will happen, right? Either for some reason that property redeems last second in the foreclosure process, right? And you feel like you wasted your time. Or you might, see the opening bid, which is typically the back taxes, like $15,000 for, $500,000 home. Great. I can spend way more than that. I'll buy it. Well, lo and behold, it sells for $350K and you were only willing to pay $250, right? Or, right, in some parts of the country, it's worth $500 and it sells for $500 at auction and you got no deal, right? And that's kind of the analytics piece that we do is say, hey, here are areas and asset classes that you're not going to get a good deal on average on, right? And here's areas and asset classes where you should get a good deal. Now, we can't say this asset's going to go for this much, but we could definitely say an on average thing and on average do much better than somebody trying to do it all blind. Otherwise, you're kind of shooting blind.
There was nothing worse than walking into class when you're in school and the teacher saying, pop quiz day. Why? Because you were unprepared. Are you unprepared, though, for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz.
In that situation, the person who's wondering where does the money go, does the money above the taxes go back to the original homeowner or does it go to the government or where does it go?
The government holds it. The previous owner, so it's basically, again, it's a state-specific thing, but it goes in order of who has right to collect those overages, right? And there's a whole industry geared around trying to recover those overages with the previous owners. But, if there was a mortgage on the property, typically it's wiped out. And so if there's a mortgage, the mortgage holder has the ability to come collect the overage amounts, right? Any other lien holders on that property have the right to go collect that. And if there's anything left over above and beyond the taxes that were due, above and beyond any of the liens that were on the property, then the previous owner has the right to that.
Super interesting. Now, I have a question just because my background was in the mortgage industry. Do investors who are buying, let's say, tax deed properties, all with cash up front, do they have a fairly simple way to cash out, refinance that money back out, let's say, after the closing? Or is there other hurdles? I mean, for some reason, I'm believing or thinking that there's title issues that would keep them from being able to do that. Walk me through those challenges.
Yeah. So there's really only 2 states you don't have to do something more, but in all of the other states, you do have to go through what's called a quiet title. It's a lawsuit that you start as the owner of that tax deed, and that's part of that underwriting the title right piece is you have to go through that process no matter what. But some of those are slam dunks, and some of those are going to be painful. Right. For example, the painful one is if the previous owner passed away, right, and that property is held up in probate court, and there's 20 different heirs, right? You have to notify all of those 20 different heirs, right? And that has a more elongated, more expensive quiet title process versus a very straightforward. The previous owner just walked away, didn't want anything to do with it. Single notice, nobody contests it, and you own that property. So you can't, right? Just to answer your question directly, Joey, you can't go to a bank and get financing immediately. You can after you get through this process, this quiet title process, which has time and has an expense. And that's all part of the very cash intensive industry because you can't get bank financing. If you could, right, it'd be closer to a mortgage industry where, yes, you can buy these at auction, but you can turn around and get financing on those right away, right? It'd be a lot more efficient space.
Well, I mean, I think that's probably what leads to higher returns in it is a higher barrier of entry, right? You got to have a lot of cash. You got to understand what you're doing. You got to be patient, be willing to wait out that title process. I mean, it's not just simple cut and dry, go pick something off the shelf. We have this instant gratification world that we live in. So it probably eliminates a lot of people. So I do want to, you talked about your fund. So I'm a tax deed investor, and my limiting factor is access to capital. I can come to your fund and basically participate in some way. Basically, you're giving me a loan or participating in the deals I'm doing. Talk about how you're partnering with people out there that just need access to capital who are experienced in this space.
So I should make clear up front, we aren't a lender. We aren't giving loans, right? Essentially, you call it a partnership. That's exactly how we look at it, and we call them profit share partners. And essentially, what's happening is they're saying, "Hey, I've got this model, right? I know how to buy properties at the right price and put a minimal amount of additional capital into those and ultimately sell them." But that takes me 9, 12 months, right? In some states, it might be 16 months. And so I can only do so much with the capital that I have. What we do is we say, okay, well, we have a platform, right? We'll get you up to speed on how to use that platform. You could submit those properties to us, right? We sign an agreement basically saying that we're going to share the profit on those deals. You submit those properties to us through the platform. We give a thumbs up, right? Or a thumbs down potentially, or maybe hey, can we correct the price? We agree. Ultimately, we agree on a purchase price, and then we go and buy that asset. So the fund is ultimately the owner of that tax deed, and the profit share partner we're working with is essentially the project manager on that property. And they get paid at the end of the day when that property sells, or we refinance it out, whatever their end goal is, then they get a percentage of that profit. The percentage of their profit is a little more complicated structure of depends on how much their deposit, like their skin in the game they want to put into it, and how long they want to hold the properties for. So that's an equation essentially at the end of the day, but that's the partners that we're working with, and that's who we're enabling, right? And we recognize this, really mid-teen, like 2015, 2016, recognized the need for capital in the tax deed space. We actually tried to work with a bank to get them up to speed, and actually got them to where they were comfortable. The bank went to the SEC to say, hey, where should we put this particular bucket of assets, right? Because there's real estate and real estate securities, and I'm not a banker. I don't know exactly how it all works. I just know from their explanation is if they put it in the wrong bucket, they get fined, they get penalized. And so they asked for clarification of where they should classify this stuff. And SEC basically said, we're not going to tell you where to put it. The banks took that as like, okay, well, we're out, because they're basically telling us no matter where we put it, we're going to get fined. And that was really, to my understanding, the only reason they didn't jump in the asset. But we'd done all this work. We got them happy. We figured, well, if a bank is happy with this model, why can't we just maybe go start a fund to provide that exact solution? We just do it directly instead of through a third party. And that's kind of how Mountain North Capital came to be.
So this is super interesting. Brian, walk me through, how long do these assets typically stay in the fund, like from on average? And then also, I don't want to assume, is the actual collateral of the properties that you're buying through these tax deed auctions significantly more than what you've invested, so that you've got that kind of backstop in the event, for whatever reason, that property didn't work out? Or, I assume at that point, there's not really a foreclosure because you own it with cash, right? So there's not like a chance of somebody not paying it. So I'm asking a question, but talking it out loud.
Yeah. You kind of shift into the, if an investor in the fund has those same exact questions, right? So on average, right, in each state and each asset, quite frankly, has a little different life cycle, but on average, it's just over 9 months. That an asset is held within the fund. You're exactly right. The fund owns the property. It's not doing a mortgage. There's no enforcement, in the events. And we've had it happen on a rare occasion. Odd thing about the structure is if the profit share partner decides to walk away for whatever reason, typically we're getting not only our portion of that profit, we'd be getting their percentage of the profit, by stepping in and managing that asset ourselves, as opposed to that profit share partner doing it, which would be great, right? And I usually get the question of, why don't you do that with everything? Well, we don't have a team built, and we don't know all of these markets. We can't manage that everywhere, right? For the volume and the scale that we're doing it. And so we definitely prefer to work with folks that know what they're doing locally, right? And we'll just share in that upside with them. That's our preference.
As an investor, tell me the question we always ask people that we're investing with is, tell me how to lose all my money.
There's certainly scenarios, right, that I either can or don't know about, right? I always go back and use COVID. That's the most recent example of, I don't think anybody estimated that COVID was going to happen. And then at the beginning of COVID, I think everybody in real estate was going, oh crap, how do I get out of this stuff? Because, the market's going to crash. And then 3 months later, anybody that was smart enough to get out in those first 3 months was going, holy crap, I made the worst decision in my life, because, market value started, skyrocketing. So there's certainly scenarios out of that, where you can get, in a very, tough position, right? Now, the fund itself, I think, Joe, you had this question earlier, I failed to answer, but we buy at less than 65% of what we call as is value. And in this space, there's really two values, right? There's the as repaired value, as we call it. It's like what the property would be worth if it were normal real estate, like anything else that's around. But the type of assets we're dealing with are not typically not the pretty properties on the street. They're the property you drive by and you're like, wow, why doesn't somebody just knock that down and start over? That's typically a tax sale property. And so the difference between the as repaired value and what we call as is value is like, what does it cost, to take it from the state it's in to that normal state? And so the as repaired value of a property might be $300,000, right? But it might need $150,000 in expenses in order to get it there. And so we term that to be $150,000 as is value, and then we buy it at 65% of that $150,000. So that's our underwriting criteria, and so we're pretty well. And we actually average right now. Last I checked, we were at like 53% of as is value is what we acquire properties at, and so there's a lot of margin in there to sell those properties at a decent profit, to where we can make what our goal is. Right, our goal is to make mid-20s. And enough left over to where the profit share partner is also making a very good return as well.
And I know you have a question, Joey, but the one question that comes to my mind is that I'm assuming you're buying insurance on all these properties just so that they don't burn to the ground and lose the rest of it.
We do, yeah. And so that does happen on occasion. We've had it happen twice in all the assets that we've purchased. And in one of those occasions, insurance did what it's supposed to do, and oddly enough, the replacement value of that property was immensely higher than what we were into it. And so we made out well. On the other instance, it burned down and ended up in this argument where the insurance was stating that, it was vacant for 60 days. And it's an ongoing scenario, so I won't talk too many specifics, but it burned down 3 days after we bought it. How do we control that timeline? So anyway, yes, those are certainly scenarios, right? We do everything we can to reduce that, but we've found the hard way of nothing's exactly bulletproof. We do everything we can, but there's certainly areas. But we like to think the assets that we're in, the value that's in them, on average, we're doing very well.
So just a really super practical, how often are you paying investors in the fund? Is it monthly, quarterly, annually? How are you paying them?
We pay quarterly. So we distribute quarterly.
Okay. And if I'm understanding just the business model, you're funding the purchase of these, and then they're on the books for roughly 9 months, but it doesn't sound, or maybe I'm missing it. Where is the cash flow from those assets? How is it being produced to be able to pay investors, or is it strictly just on the exits of those just kind of piling up that are being paid out to investors? How does that work?
Yeah, so that's the volume, right? The volume that we're doing at this point allows us to do that. Now, the key part of our fund is that we do have a backstop lender that provides 90% of the capital needed on any purchase, and so the investment in the fund really ends up being 10% of the capital needed. And the really unique thing of the bank structure we have is they're actually paid when we're paid. There's no interest payment to that group, to that particular group. Until the asset's paid, that's when they collect. It's an accrued interest scenario. And so because the 90% of the cash that we have sitting out there is in an accrued scenario, the sale of those assets provides what we need to pay out investors on a quarterly basis.
And so then is the fund becoming on title or on the deed and that's being recorded until it's sold? Is that the way that the fund is protected?
Correct. Yeah. So every asset that's purchased, we're the non-North Capital or one of our subsidiaries is the owner on title. Correct.
Yeah. And ultimately the distribution of these or disposition of these assets are being sold at auctions, or they're being sold on MLS, or all the above?
All the above. Yeah, I think it's depending on the asset, right? If it makes sense to list it with a local realtor because we can get it in a decent shape, or we put enough money into it where it makes sense to sell it to somebody wanting to make it a home, that's what we do. If it makes more sense to say, hey, we bought it, at this auction, let's put it on another auction that has a wider audience, that'll appeal to somebody that's willing to pay twice as much. We leave all options on the table.
So kind of lightning round here. I'm a tax deed investor. How much experience do I need to have in order to be able to partner with you guys? What are some of the minimum criteria that you're going to have?
Well, if you're the investor looking to partner with us, it's not a lot, right? As long as you bought a tax deed, then you've crossed a giant chasm, and you've educated yourself enough to where we feel we are going to be able to look over your shoulder enough to where we're protected. Now, if you haven't bought that first tax deed, you could cross that fairly quickly, right? But that is a very wide chasm. So that's the main thing, because ultimately we're underwriting the asset. We're not necessarily underwriting the person. We want them to know what they're doing, right? And we go through an interview process, but we're not doing credit checks, right? I don't really care what their credit is, as long as they're buying the right assets, which we verify every single time, then we're comfortable.
And if I'm an investor, same question. Like I think you mentioned that your fund's an accredited investor thing, kind of minimums. It's what criteria do you have of me of an investor?
It is. So it's a 506c. So you do have to be accredited in order to join. We do have a $50,000 minimum entry into that, and then it's a two-year lockup.
And what sort of rates are investors seeing typically in a fund? Is it floating? Is it fixed? Like, how does it work for the actual investor?
So every time we bring capital in, right, it could vary. Right now we're offering a 16% rate. I guess the selfish part of me is over time, as we do more and more, and there's a lot higher demand, right, for the little bit of placement that we have avenue for, right? We're not there right now. We're at about a $40 million fund at the moment. We feel like we can grow that significantly, and so we're in very much capital raise mode, and will be now. Ideally, down the road, when we fill that bucket up and we say, hey, we're as big as we think we can get in this space, then the focus will be, how do we minimize our cost of capital? But we're a long ways from that. We're a couple of years from that. So we'll be offering that 16% note for a while.
Well, I'll tell you, Brian, I don't know, Russ, if you have any other questions, but what I've gathered is that the tax lien, tax deed investing world, super profitable if it's done right. And that there's ways in which if you are called to get into the tax lien, tax deed investing world, there are people like Brian and Tax Resources that can support you both from a software standpoint, and it sounds like even from a capital standpoint to get deals done. And then for the last person, the person that's just looking to be a passive investor that may really align with this. We talk about this, Brian, on the show, the investor DNA, your profile, your personality. What are you really designed to invest in? If you align with this strategy, but you don't have the time, you could then potentially be a part of the fund that you're talking about. So I think we've hit it from all angles as it relates to whoever's listening. And for those that want to learn more, where would you direct them, Brian?
Well, I think if you're interested in the fund side, go to mountnorthcapital.com. If you're listening, you're like, you know what, I think I'd like to do that myself and use the tools that they have, which ultimately we want to work with those folks too. They can become a local profit share partner, ideally, is what we're looking. So if you're looking for the tools, then you can go to taxsaleresources.com.
Excellent. Well, Wealth of that Wall Street tribe, I hope that this has been valuable, that you have learned something new, maybe even potentially your current path that you need to be on to get to financial freedom. If you found value, please share this with somebody else who you think may be stuck in a 9-to-5 or maybe out of alignment with their life, and they need to get to financial freedom as fast as possible. As always, have an amazing day.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.